Okay, guys. So you should be able to hear me. You can hear me, right? So welcome to you guys can hear me.
Yes, Faiz.
There's just something wrong. Something wrong with my internet. Just give me a moment. Something not working here. I'm just really gonna check my internet. Just give me 2 minutes. Okay, so I think it should be fine. So welcome to class 2 of your 8 classes. And so this is the second class for financial reporting. What we're going to do today, we're going to work through the revenue question. Okay, so I'm going to take you through the steps of the revenue question, and I will talk through it, and then you can ask any questions, and we can apply it specifically to this particular question. What you must take note that this question is a discussion question. There's hardly any calculation. So you must be able to discuss a revenue question, and you can see it is 25 marks. Okay, so you want to be able to calculate, but in most of this question is about a discussion. So remember, the revenue standard has 5 stages, right? Or whatever you want to call it. Okay, so it has 5 parts. Let's call it 5 stages. So they told us specifically in this question, we must ignore step 1 and step 4. So that means we need to do step 2, step 3, and step 5. Now, step 1, let me just quickly open up Excel quickly. They should be able to see Google Sheets. So remember, the revenue model has 5 steps. Okay, so the revenue model has 5 steps. Okay, so we will have step 1, step 2, and then we'll go all the way down to step 5. Okay, now in step number 1, it is basically a contract with a customer. Okay, so step 1 deals with a contract with a customer. Okay, step 2 deals with identifying the performance obligations. Okay, so this is always a big one, identifying the performance obligations. Now, step 3 is to determine the transaction price. Okay, so step 3 is to determine the transaction price. Step 4 is to allocate the transaction price between the separate performance obligations, between the separate performance obligations. And then step 5 is to recognize revenue. Okay, so recognize separate performance obligations. So that is the 5-step model. Step 1, determine a contract, whether you have identify the contract with a customer. Step number 2, identify the performance obligations. Step number 3, determine the transactions price. Step number 4, allocate the transaction price between the separate performance obligations. So what's important to note, you can only do step number 4 after you did step number 2 and step number 3. If you don't have either step 2 or step 3, you can't do step 4. And then lastly, you must recognize revenue for the separate performance obligations. Okay, so that's the 5 steps. Now they told us ignore step 1 and ignore step 4. So they said ignore step 1 and ignore step 4. Okay, so we're going to ignore step 1 and step 4, and we're going to focus on step 2, step 3, and step 5. Now, step 2 is one of the biggest ones. Okay, so step 2 is one of the biggest ones in the real world and also from a theory point of view. Okay, so you must be able to handle step number 2. So what does step number 2 deal with? It deals with identifying the separate performance obligations. Okay, so identifying the separate performance obligations. So what's important to start off with? So what is important to start off with when you read a contract? You need to identify this, all the promises within the contract. So what's important when you read a contract? You need to identify all the promises within the contract. So using this particular question, what we're going to do, I just want to get the question paper out quickly. Just give me a moment. So what we need to do is to identify all the promises within the contract. Once we have identified all the promises within the contract, we then need to ask ourselves, are these promises separate performance obligations? Okay, so that is the thinking. So the thinking would be, first, once you're dealing with step number 2, when you are dealing with step number 2, first identify all the promises within the contract. Once you have identified all the promises within the contract, only then can you try and determine the separate performance obligations. Because if you can't identify the different promises, then what are you going to use to determine separate performance obligations? Okay, so that's important. So let's deal with it over here. Okay, so let's deal with it over here. Okay, so we deal with step number 2. Okay, so step 2, and this is identify separate performance obligations. Okay, so that is step number 2. Now, like we said, before you can identify the separate performance obligations, we first need to determine the different promises within the contract. So remember, IFRS 15 revenue talks about promises. Okay, so what are the promises within a contract? So remember, we must look at the general contract. And we must also look at the contract specific with pick and drop, because that's what the question is about. So the promises is basically it is the provision of so it's a provision of the checkout of self-service checkout machine. We already saw the picture in the scenario, so you can picture the picture. It is software loaded on the machine. It is technical support. So this is all listed in the, if you read the scenario, you should be able to pick up all the promises, all the services, all the goods and services, all the promises within the contract. Okay. It is assistance by an associate, and then it is a warranty. Okay, so that is all the promises within a contract. So now that we identified all the promises within the contract, we now need to ask ourselves, for each of these promises, is it one performance obligation, or are they separate performance obligations? Okay, so that is the question. Once we have identified the different promises, then from there we need to identify whether these promises is one performance obligation, or is it separate performance obligations. In the same way, I'm not sure how a cell phone contract works in Zimbabwe, but here in South Africa we have like MTN, Cell C, Vodacom, Telkom. Those are the typical. Those are the most common cell phone operators, what you want to call them. So when you go there and you take out a cell phone contract, a smartphone contract, you enter into a contract typically for 24 months. Okay, so let's say you pay 500 Rand for 24 per month for 24 months. Part of the contract would say you're getting a phone, you're getting data, you're getting airtime, you're getting data, you're getting minutes, you're getting SMSs, and you're getting a phone. So what is the promises within the contract? The promises within the contract are the four things: phone, data, minutes, and SMSs. Those are the four promises. Now that we know the four promises, we need to identify, given the circumstances, whether each of those promises is a separate performance obligation, or are those promises one performance obligation. So same thing over here. So now that we have identified the promises, now comes the big step, and that is to identify the separate performance obligations for each of these promises. So how do we do it? That's the big question. So IFRS 15 says, in order for each promise to be a separate performance obligation, the items needs to be distinct. Okay, so for the promises to be separate performance obligations, the items need to be distinct. The good or service promised to the customer needs to be distinct. So that is the first point. Okay, so the first point would be products. Obviously, you can look at your solution and you can write it in better terminology. I'm giving you the thinking process and the theory and the thinking of the theory. So I'm giving you a process of thinking, and also as well as applying the theory to the scenario. You can write it into your type of words, but remember what you want to do to make sure you maximize your time as well as maximize your marks. You must write in bullet point. Okay, so make sure that it's one comment or one statement per bullet point. Don't write paragraphs, because generally if you're writing a paragraph, it just becomes so messy that the examiner don't see the different points. So they only see one point. They give you one mark, yet you wrote about two things. So therefore, make sure each bullet point is only one. You're only saying one thing per bullet point, and try to keep your one bullet point to one sentence. Don't write one line, 2 lines max. Okay. So here we're going to say products and services promised to a customer. So I just want to make one point clear first. Okay. So the first thing to make mention to say that a promise, good or service is a separate performance obligation if they are distinct. Okay, so that is what you're telling them. So remember, we identified, so here we're just going to say promises within the contract. Okay, so here are the promises within the contract, those. Then we say a promised good or service, so this is a promised goods or service, is a separate performance obligation if they are distinct. Okay, so that's what we're saying. Because remember, we're trying to identify whether we need to identify separate performance obligations. In order to identify separate performance obligations, first identify the promises within the contract. Once you have identified the promises within the contract, you now we go through the process of identifying the separate performance obligations. So we tell them that a promised good or service is a separate performance obligation if they are distinct. Okay, 1 point, 1 sentence. Okay, so 1 sentence per point. Next point. Now we tell them products and services promised to a customer is distinct. Is distinct if both criteria, I call it criteria, if both criteria are met. Okay, so remember, both criteria must be met, not one. Both must be met. So in many cases, one of it will be met, but the other one won't be met. Then that means it's not distinct. Okay, so that's important. Now you can write out the proper wording from an IFRS 15 point of view. I'm just going to give you the basic wording. Okay. Okay, so you're happy with that? Okay, so the first one is products and services promised to a customer is distinct if both criteria are met. What are the criteria? So one, so number one, the promises are capable of being distinct. Okay, so what does this mean? So it's capable of being distinct. Okay, so it's capable of being distinct. Let's put it in the next point. This means the good or service can be used or benefited on its own or together with other services. Okay, so let's explain this. Together with other services. Okay, so basically the second point is just giving an explanation of what this means. So promises are capable of being distinct. What does that mean? What is something capable of being? It's capable of being distinct. It means the good or service can be used or benefited on its own or together with other services. So what does that mean? So let's go back to a cell phone contract, right? If you go buy your cell phone, right? Are you happy that the phone can be used without without taking out data and minutes. And so if I go buy me a cell phone at Vodacom, there's no need for me to take out a contract with minutes, data, and airtime. With minutes, data, and with minutes, data, and SMSs, I can simply just buy the phone, because the phone on its own can be used. The phone, I can benefit from the phone without any other services. Or I can simply buy the phone from Vodacom and then go to cell C to buy data. You can see I can use the phone together with other services. I can use the service of MTN's network. I don't need Vodacom's minutes, data, and so forth. So as you can see, the phone is capable of being distinct, meaning I can use it on its own or with other services. Okay, do you get that? So same thing in this particular question. Just give me I was getting a call. Hello? Hello? Okay. Okay. Who am I speaking to? Can you call me a bit later, please? I'm in a class. Can you call me a bit later? Because I want to show you a huge opportunity to grow up financially. Okay, so just think about what you call it, right? So that is basically capable of being distinct. So if we think of it in terms of this particular question, so we're gonna have, so what you must know, we're gonna have to discuss each of these, because remember there are seven, I mean, yes, how many? 1, 2, 3, 4, 5. There are 7 different promises. So for each promise, we need to ask ourselves, can it be used on its own, yes or no? So remember the provision of the self-service checkout machine, it is capable of being distinct because Gibela sells a machine on its own, and a customer can just buy the machine from Gibela and then buy software from another entity. Okay, so you know they can buy from a foreign entity. So therefore, the provision of the self-checkout machine can be used on its own. Okay, so take note of that. Similarly, if I remember correctly, the software is sold separately by Gibela. Okay, let me just want to check if that is correct. Cannot remember. Okay, so just take note. Okay, I can't now see, but basically, what you must know that the machine is capable of being distinct. Why? Why is a machine capable of being distinct? What makes it capable of being distinct? Because the machine can be sold separately. Although the machine can only operate with the software, the fact of the matter is I can buy the software elsewhere. I can go and buy the software from a foreign company, and that means the machine is capable of being distinct. And the fact that the software is sold separately, that means it is capable of being distinct. So that's important to take note. If you can enjoy the benefits separately, if you can acquire something separately, so I can buy the checkout machine separately, I can buy the software separately. If something is sold separately, it implies it is capable of being distinct, meaning it can be used on its own or it can be used with other services. Okay, so that's important to understand. Do we have any question at this point in time? Any questions? Nothing? Can I go on?
Nothing from my side.
Okay. Now, the same thing with the technical support. Is the technical support capable of being distinct? if I remember correctly from the scenario, the technical support is sold separately by Gibela. Because technical support is sold separately, it implies that the technical support is capable of being distinct. So it meets criteria number 1. Okay, so the provision of the self-service checkout, the sale of the self-service checkout can be sold separately. So therefore, it meets point number 1. The software is sold separately. So therefore, it meets point number 1. Technical support is sold separately. So therefore, it meets point number 1, capable of being distinct. Okay. Okay, so that's important to understand. Okay, so you're happy with that? Then the assistance by an associate. Now, what you must understand, the assistance by the associate, so Gibela don't provide assistance with the associate on its own. You only get an assistance from the associate if you take out the contract, right? So only as a result of taking out the only as a result of buying the entire service do you get an assistance. Do you get an associate. If you do not buy, you can't get an associate separately. So as a result, it does not meet point number 1. The assistance by an associate is not capable of being distinct, meaning it cannot be enjoyed on its own. You can't just get the assistance, the associate. You must, in order to get the assistance from the associate, you must enter into the contract with Gibela. Without entering into the contract, they don't sell it separately, so therefore it is not capable of being distinct. Okay, so that's important to understand. Are we okay with that?
Yes, fine.
Okay, so we can move on. Okay, so now the last one is the warranty. So the warranty, there is a, I don't know if do you have IFRS books? Do you have the IFRS books? Just give me an indication if you have the IFRS books. Anyone?
Yes, I do have one.
Just if you have the IFRS book, just give me a thumbs up, all of you. If you don't have it, just give me a thumbs down. I just want to see how many of you have it, how many of you don't have it. Just keep your thumbs there. Anyone else? Okay, so why this is important? Why I want, because there's quite a bit of guidance with there's quite a bit of guidance in the standard regarding a warranty, and they give you exactly. So it depends on the structure of a warranty, whether a warranty is a separate performance obligation or whether a warranty is not a separate performance obligation. So when it comes to a warranty, if there is not, if there's no additional value other than protecting the item, then the warranty is not a separate performance obligation. But when there's some additional benefits, so there's exact guidance in IFRS to explain this. So when a warranty is simply, so when you provide a warranty simply as to make sure that the item operates as it must operate. So you will replace it if it does not operate as it must operate. But you have nothing to do with all the warranty does is there to ensure the item operates as it should operate. If it's nothing beyond that, then the warranty is not a separate performance obligation. So in this case, the warranty is solely there to ensure that the checkout machine operates as it should operate. So if the checkout machine does not operate as it should, you can replace it or they repair it. So that is all that the warranty does. In that case, the warranty is not a separate performance obligation. So that's important to understand. Okay, so that you might just know. So if you want to, there is in the application guidance. So remember the new IFRS standards. So sorry, just someone by my door quickly. Okay, so so just take note of that. Okay, so that means over here, this one meets point number 1. So it is capable of being distinct. It is capable of being distinct. It is capable of being distinct, not capable of being distinct. And this one, because it is the warranty, because it is not a it's solely there to ensure the product operates as it should operate. It means it is not a separate performance obligation. An indication where a warranty is a separate performance obligation, it is when a company sells warranties separately. Okay, so if a company sells warranties separately, that indicates that the warranty is a separate performance obligation. In this scenario, they don't sell warranties separately. The warranty is only there to ensure that the product operates as it should operate. That's an indication that the warranty is not a separate performance obligation. Okay, so that's important. Now we go to point number 2. So remember, in order for an item to be in order for a promised good or service to be a separate performance obligation, it must be distinct. And a good or service is distinct if it meets 2 criteria. So criteria number 1, promises are capable of being distinct. What is capable of being distinct? Capable of being distinct, as we said, it is you can use it, benefit it on its own or together with another service. An indication that you can use it on its own, an indication that you can benefit you can benefit from the good or service with other services. It is when that item is sold separately. That's an indication. Okay, now the second one is the good or service is distinct within the context of the contract. Okay, so the goods or service is distinct within the context of the contract. Okay, so that's important. So so that is an important point. So let's understand what we mean by this. So number 2, the goods or service is distinct within the context of the contract. So what does that mean? That is the important aspect. What does it mean? So let me give you an example that will most likely make it clear to us. Okay. If you take an architectural company, so typically a company that does architect services, you can just Google them and you will see. Just Google architect companies and you will see what kind of services they provide. They provide a range of services. So just to make the example more simple, just to keep it simple, let's just say they offer typically drawing up plans, like architect plans. That's one. Number two, they provide interior designing. So we know what's interior designing, right? They provide a service where they lay out how the inside of your house must look, which furniture to use, and all of those type of stuff. Okay, so that is interior designing. And then they also provide project management. Now, you could either enter into an agreement with the architect company only to draw up your plans. Or you can enter into an agreement with an architect company only to do your interior designing. Or you can contract with the architect company to manage the project. So the project management services. Now, the project management services means they must look after their job is to manage the entire project. That is project management services, right? So a project management service is where they basically look after the entire project from start to finish. Now, within a project management services, there are different promises that take place. For example, within project management, they will have, their part of their job is to ensure the drawing of the plans get done. Part of project management is to ensure that the actual building gets done. Project management services implies that they must also ensure that interior designing gets done. Okay, so understand that. So when you look at it, if you what was it now? If you what was I trying to say with my train of thought? Okay, so if you enter into an agreement with the architect company to provide the project management services, we would have to ask ourselves, is the project management service one performance obligation, or is the project management service separate performance obligations? So let's have a look. In order for the project management services to be separate performance obligations, the goods and services promised within the contract must be distinct. Okay, so that's the first point. Then we're saying, in order for products or services promised in a contract to be distinct, they must meet two criteria. Criteria number one, they are capable of being distinct. What did we say is capable of being distinct? An indication that an item is capable of being distinct if it is sold separately. So like I said, within the project management services is the drawing up of a plan, is the interior designing, and so forth, right? So we know that the architect company sell the drawing of plan service separately. We know that they provide interior design services separately. So it meets criteria number one. It is capable, within that project management services, the various promises can be sold separately. So therefore it meets point number one. It is capable of being distinct. But now we must do number two. Number two is the products or services is distinct within the context of the contract. What do we mean over there? Despite the fact that within the project management services, there are different promises, the drawing up of the plans, the building, the interior designs, the agreement between us and the architect company is not for the drawing of the plan. It is not for the building. It is not for the interior designs. We contracted with the architect company to manage the entire project, which means when the project is done, what do we want? We want a completed house. So in order to have a completed house, the project manager has to do all of those services. But given the context of the contract, we contracted with the architect company to provide us a completed house. So even though the project management have different promises that are capable of being distinct, within the context of the contract, we don't want the separate performances. We just want a completed house. So in that instance, the project management services, given the context of the contract, it is one performance obligation. So this is what this item mean over here. Is it distinct within the context of the contract? So now let's have a look. Over here, the provision of the self-service checkout and the software, given the context of the contract, although the checkout machine can be sold separately, although the software can be sold separately, the way the item is, the way the contract is structured is that the machine can't operate without the software. So within the context of the contract, the machine and the software is one performance obligation, which within the context of the contract, the machine and the software is needed for each other. It plays an integral part. It plays an integral part. The software is an integral part of the machine. So based on that, it implies that the software and the provision is not distinct within the context of the contract, and as a result, it is one performance obligation. So although it meets point number one, the machine is capable of being sold separately. The software is capable of being distinct, but is sold separately, but it does not meet point number two. Point number two says the software and the machine is distinct within the context of the contract. Given the context of the contract, because the software plays an integral part of the machine, the machine can't operate without the software. So given the context, it implies that the software and the machine are not distinct within the context of the contract. Therefore, it does not meet point number two. Therefore, it is not distinct, and therefore it is not a separate performance obligation. So therefore, these two so far is one performance obligation. So just make sure you can understand that. Okay, so let that sink before we move on. Do you have any questions on that? Any questions before we go on?
Not from me, Faiz.
Can you kindly come again on the issue of the second point, which is the I5?
Yes, I'm listening. I'm listening. Are you there? Hello?
I was saying that, can you kindly come again on the second point?
Oh, okay, so let's do it. I'll who asked that question? I'm trying to see. Dinashi, was it you or Walter?
I think it's Walter was trying to talk to you.
Okay, so you want me to come again on the second point, okay? So with the issue of, so remember, in order for a good or service to be a separate performance obligation, the goods or service must be distinct. In order for it to be distinct, it must meet both criteria. Criteria number one, it is capable of being distinct. Criteria number 2, it is distinct within the context of the contract. Now, something is capable of being distinct if it is sold separately. Okay, so for example, in this one over here, the machine and the software are sold separately. So it meets criteria number 1, which is capable of being distinct. But does it meet criteria number 2? That's the question. In order for it to meet criteria number 2, we must have a look if it is distinct within the context of the contract. What makes it distinct within the context of the contract? So if you have a look at the scenario, the software and the machine plays the software is an integral part of the machine. Without the software, it is not, the machine can't work. So that indicates that the software plays an integral part of the machine. So given the context of the contract, because the software is an integral part of the machine, it means that it does not meet point number 2. It is not distinct within the context of the contract. So that means because point number 2 is not met, the machine and the software are not two separate performance obligations, but rather they are one performance obligation. Okay, so that's important to understand. Okay, so that's important to understand. So far, we have concluded, let me just make this bold. So we have concluded so far that the provision, the machine and the software is one performance obligation. We also concluded that the warranty is not a separate performance obligation. So therefore the warranty, the machine and the software is so far one performance obligation. We know that the technical support can be sold separately, and we also know it is distinct within the context of the contract, because within the context of the contract, you don't need the technical support. So as a result, it is distinct. So that the technical support is a separate performance obligation, whereas the associate is not a separate performance obligation, because we already said that it's not that the associate cannot be the assistance by an associate is not capable of being distinct. So it does not meet point number 1. The fact that it does not meet point number 1, there's no need to look at it from point number 2. So remember, if it does not meet point number 1, there's no need to look at point number 2, because it must meet both criteria. So if it does not meet criteria number 1, there's no need to look at criteria number 2, because it must meet both. Okay, so you get the logic. Because it does not meet criteria number 1, there's no need to look at criteria number 2, because it must meet both. So even if it meets criteria number 2, the fact that it does not meet criteria number 1, it's not going to be distinct. So this one and that one was not capable of being distinct, so therefore did not meet criteria number 1. So we already know that this was part of the provision of the machine. But when we went to point number 2, we also identified that the software is an integral part of the machine. So therefore, that is also not a separate performance obligation. So the conclusion is as follows. The conclusion is as follows. There are two separate performance obligations. Okay. And what are the two separate performance obligations? It is the machine software, what's the other one? Associate and warranty. So that is one performance obligation, because it either did not meet criteria number 1, or it did not meet criteria number 2, or it did not meet both. Okay, and then the second one is the technical support. So those are the So those are the two separate performance obligations. Remember, there's not a full answer here. What I discussed, you obviously have to, so for this over here, I'm just giving you the important points, but then you must discuss it in terms of each of these promises, okay? So we discussed for the machine, it is capable of being sold separately. We discussed for the software, you can buy the software from another supplier. We see the technical support is sold separately. So that one, and that one met criteria number one. This one over here does not meet criteria number one. Why does it not meet criteria number one? Because it is, how can I say now? Because we don't sell it separately. Okay, you only get it as part of the contract. And then we also said the warranty, because it is not sold separately, and because it is only there simply to make sure the machine operates as it should operate, it is not a separate performance obligation. It is not capable of being distinct. So therefore, that one met point criteria number one, met criteria number one, met criteria number one, did not meet criteria number one, did not meet criteria number one. So because these two did not meet criteria number one, there was no need to look at criteria number two. Because these three met criteria number one, we had to look at criteria number two for those three. Okay, because remember, it must meet both. All right. I don't know. Don't you go and check ready, man? It's in the outside. I don't want to go check quickly. I just message you now. Mr. D. Sorry, people at the door. I can't go now. Okay, so does that answer your question? I think it was Walter.
Yes, it does. Thanks, Vice.
Okay, so that is basically, so just please make sure that you go through the scenario and the solution to actually put down what I explained, why it meets point one, why it does not meet point number two, and so forth. Okay, so that is step number two, giving the main criteria. But remember, a lot of the mark is lying to show them why you're saying it meets point one or why you're saying it meets point two, and so forth. Okay, so what you must know that there are two separate performance obligations, that and the technical support. So what made the technical support a separate performance obligation? It met point number one and it met point number two. Okay, so it met point number one and it met point number two. Okay, so point number one is so met point number one and point number two. So remember, for technical support, it is capable, it meets point number one because it's capable of being distinct. What makes it capable of being distinct? You can benefit it from it on its own. How do you benefit? How can you benefit from it? How can you benefit from it on its own? It's because you can sell it separately. Okay, I mean, you can, because Gibela sells it separately. You don't need to take the whole contract. You can just hire the technical support. And then it is distinct within the context of the contract. What makes it distinct within the context of the contract? If you had a look at, if you read it carefully, it said that they will put the technical support there for 3 months, and you then can decide whether you want to keep the technical support on, or whether you're gonna use your own employees for the technical support. Okay, so that makes it clear that given the context of the scenario, given the context of the contract, that the technical support is a separate, is a distinct, is distinct within the context of the scenario, because there's no need to keep the technical support on. The technical support does not play an integral role in operating the machine. It's only there to help you, but you can operate it without technical support. Okay, so that is basically what why it is a separate performance obligation. Where the machine, software, associate, and warranty, what makes it one performance obligation? We said the machine and the software met criteria number 1. It was capable of being distinct. Why? You could benefit from it on its own. How could we benefit from it on its own? It was because it is sold and provided separately. Okay, so it met criteria number 1. The associate and the warranty did not meet criteria number 1. The associate, you only get the associate because it's part of the contract. They don't sell the associate systems separately. So that is why it did not meet criteria number 1. For the warranty is also not sold separately. The warranty is simply there to make sure the product operates on its own, operate as it should operate. So therefore, the warranty is also not capable of being distinct. So that meant associate and the warranty did not meet criteria number 1. Because it did not meet criteria number 1, there's no need to do criteria number 2, because even if it meets criteria number 2, it's still not going to be distinct because it did not meet criteria number 1. But because the machine and the software met criteria number 1, we have to have a look whether it also meets criteria number 2, because it will only be distinct if it meets criteria number 2 as well. So when we looked at criteria number 2, we had to have a look whether it is distinct within the context of the contract. Given the context of the contract, because it plays an integral role, it plays an integral part, the software plays an integral part in the machine operating. That meant within the context of the contract, the machine and the software is not distinct, because within the context of the contract, the one plays an integral part with the other. So therefore, it makes them one performance obligation. Okay, so that is basically it over there. Now, we must do step number 3. Okay, so step number 3, determine the transaction price. Okay, so step number 3, determine the transaction price. So when we determine the transaction price, we just look at the full amount for the entire contract period. So we look at the full amount for the entire contract period. Okay. So what is the full amount for the entire contract period? So let's have a look. Okay. So the transaction price for the entire contract period was given to us as 45,800. Okay, So the price was 45,800. Okay, so it was the contract price is 45,800. I'm going to use the word rand just to it's easy off my tongue, but you know I'm referring to I'm thinking that's Zimbabwe dollars, right? Okay, so the contract price, I'm just going to say dollars. Okay, so the contract price is $45,800. But what do we know? This price includes VAT, therefore need to remove VAT. Why do we remove VAT? Because it is an amount collected on behalf of a third party. Okay, we only want an amount that is collected on behalf of ourselves. We don't want an amount that is collected on behalf of someone else. So VAT is collected on behalf of a third party. So therefore we must remove VAT. Okay, so remember the way we're going to remove VAT, we want 100%. So we're going to say 45,800 multiplied by 14.5%. 14.5%. So this here is going to be equal negative 45,800 multiplied by 14.5%. Okay, so that's the VAT. So the net amount, therefore, no, sorry, not 14.5%, 14.5 divided by 14.5 divided by 114.5. Okay, because that 45,800 is inclusive of VAT. So I must say divide by 114.5. Okay. So therefore, the gross revenue, therefore the gross contract revenue is whatever this amount is. Okay, so let's just work it out. So it's going to be equal sum. Okay, so it is $40,000. So the gross revenue is $40,000. Okay, but what do we know? That what's important to take note, that you must always take into account any discounts, you must take into account any variable consideration, and you must take into account any significant financing component. Okay, so we must always take into account any significant financing component. Okay, so what we must say, the transaction, when determining the transaction price, so when determining the transaction price, the effects of a variable consideration and significant financing component must be taken into account. Okay, must be taken into account. Okay, so that's important to understand. So we must always take into account variable consideration and a significant financing component. Now we know that there is variable consideration. The discount is a variable consideration. Okay, so the discount. Okay, the effect of the discount. Okay, so in the scenario, they told you there will be a 10% discount as well as a 10% discount on the contract price, as well as a 5% discount on the machine. Okay, so that's important to understand. Okay, so the effect of the discounts. Okay, effects of the discounts, it is 10% on the transaction price, okay, and then also 5% on the machine, okay, on the checkout machine. So if we have a look at the transaction price is 40,000, 1, 2, 3. Okay, so the transaction price is 40,000, 1, 2, 3. And the discount is 10%. So we say multiply by 10%. So therefore, we're going to have, in the right column, yes. So we're going to have equal negative 40,000 times 10%. Okay, so the discount is 4,000 Rand. Now we must have the discount on the machine. As a 5% discount on the machine. Now remember, the machine was 11,500 Rand. Okay, $11,500. Now that $11,500 was inclusive of VAT. We want the exclusive of that amount. So we're going to say multiplied by 100, divide by 114.5. Okay, so that answer over there gives us the exclusive VAT amount of the machine, but we want a discount of 5%. So what is going to equal negative 11,500 multiplied by 100 divided by 114.5. So as you can see, 10,043, that's the exclusive VAT amount. And then we're going to say multiply by 5%. So that would be whatever the discount is, 502 Rand. Okay, so that means the net transaction price. Okay, so therefore, the transaction price after taking the discounts into account, discounts into account is whatever this is. Come on. It is equal to the sum. Okay, so it is $35,498,000. Okay, now we have to factor in. Now we will have to factor in the. Now we'll have to factor in the significant financing component. Okay, so for a significant financing component, so what's important to understand that we have to take into a significant financing component. So when do we have a significant financing component? If a customer pays in advance for the goods or services. Okay, so for example, if you take out a contract, right, you pay 500 Rand per month while you're receiving the data, the minutes, and the airtime, right? So I'm paying 500 Rand a month, and the 500 Rand a month is for a phone, data, contract. What did I say? Data, phone, contract. Oh, what did I say? Data, phone, minutes, and SMSs. So let's say I pay 500 Rand for those. Now, every single month I pay a 500 Rand, and every single month I get data. Every single month I get minutes. Every single month I get SMSs. So as you can see, the portion of the 500 Rand that relates to the data, minutes, and SMSs coincide. I pay monthly and I receive the services monthly. However, the cell phone I get upfront while I pay it off over time. So there is a significant financing component. Okay, so that is basically what we need to understand over here. Now, we will have to identify which items have a significant financing component and which does not. Okay. I was going to look through the scenario quickly. Let me just quickly see. So I'm going to look at the scenario quickly. Give me 2 minutes. Where is this now? Oh yes, it's claim. Okay, so if you go to point number 6 under, if you go to point number 6 under under note number 1, point number 6, just tell me when you're there. Just quickly go there.
As you said, not what?
Note 1.6. Just tell me when you're there.
Yes, we are there.
Okay. So what you must understand over here is the following. So here they're telling you, and in point number 6, they're saying, due to the steep capital investment associated with constructing a single self-checkout machine, supermarkets are expected to pay 50% of the contract price relating to the self-checkout machine upon delivery. The rest of the balance and other items provided in the contract will be paid for evenly over a period of 36 months. So when you have a situation where you pay evenly and only a portion is paid up front, So here you can see only 50% of the 50% of the checkout machine is paid up front. So only that portion will draw a significant financing component, because everything else will because everything else, checking the checkout and self-service, okay, because everything else will be provided over a 36-month period. So the rest of the balance you pay over 36 months, but the checkout machine, only that is paid with a 50% upfront. So because that portion is paid upfront, 30%, we will have to work out a financial component relating to the checkout machine. Does that make sense? Does that make sense? Yes or no?
It makes sense.
Okay, so just make
So
sure you
only
can.
use the 50, confirm that we are now taking the 50% out of our transaction prices.
Yeah, so I'm going to show you how to do it now. Okay, so I'll show you how to do it now. Let's see. Okay. So now, significant financing component. Significant financing component. How do we work that out? So we need to just basically work out the, how can I say now what we need to work out? We need to work out a present value. Okay, so we want present value. So this is make a point. So just to make an important point, so you know that a significant financing component financing component will.
Your screen is up, guys.
Oh, sorry, my mistake. Where am I now? Okay, you should be see it now. Can you see it now?
Yes,
Okay.
we can.
A significant financing component will be applicable where payment do not coincide with the delivery of the goods or service. Okay. I don't want to use the word delivery, but rather, though it does not coincide with the transfer. That's, I think that's the term that IFRS 15 use, transfer. Okay. In this case, 50% of the checkout machine is paid up front, while the rest is paid over the 36 months. Okay. Therefore, a discount, therefore a financing component is applicable to the checkout machine. Okay, so now we're going to work it out. So when you want to work out, all you're going to do is work out the present value. Okay, so all we're going to do is work out a present value. So what do we need? We need the present value. So that means we need to work out what is the future value. We need to work out PMT. We need to work out N. and we need to work out I. Okay, so we want the present value. So to get the present value, we're going to need everything else. Okay, so what only 50% was paid up front. Okay, so only 50%. So only 50% was paid up front. So therefore, only 50% is as a financing component. So let's work out. N was paid immediately. So therefore, it's over a 36-month period. So N is 36. Okay. So what is I? So let's go have a look. I just want to go see what is I in the scenario. I think I was under the additional information. Where is this now? Just need to stop this quickly. Just need to just see where is this. Okay, so I was right at the bottom in the scenario under additional information. So remember they said a post-tax rate of so if you go to additional information, you can see under the first bullet point, right at the bottom under additional information, it says assume Gebela use an annual post-tax discount rate of 12% where appropriate. Okay, so 12% where appropriate. Now, now remember, so they are using 12%. So I is 12%. But remember in accounting, in MAC, we use a post-tax rate, meaning an after-tax rate. In accounting, we use a pre-tax rate, a before-tax rate. So the 12% is a before-tax rate. So to actually get the correct amount, we must divide it by 1 minus, what was that now? What is your tax rate? 24 point what? What's the tax rate? 24.72. Okay, you should be able to see. So the tax rate, so the discount rate that they gave us is 12% after tax. In MAC, we want 12% or we want an after tax rate. But in financial reporting, we need a before tax rate. So because the 12% is after tax, we need to convert it to before tax. The way we do it, we simply say say the rate divided by 1 minus the tax rate, which is that percent. Okay, so to get I, what we're going to do, it is 12% divided by 1 minus 24.72%. Okay. Okay, so okay, so that's important. But now what's important to understand over here, that 15.94, that 15.94%, that is an annual tax rate. Because N is monthly, I must also be monthly. So to convert this to monthly, I will just divide by 12. Okay, so therefore, I is 1.3% per month. Just make sure you can handle this, right? Because this is easy marks. Okay, so that is an easy mark. So just make sure you can handle it. Then we have 36. Now I must work out PMT. What is PMT? PMT is basically the monthly payment. So the monthly payment is monthly payment is Let's think now what's the monthly payment. So the monthly payment is 50% of, so remember the monthly payment is going to be 50% they paid up front, 50% they're going to pay over the point in time, over the 36 months, right? So remember, what is the amount that they're going to pay over 36 months? It should be 11,500. That is the amount inclusive of VAT. We don't want an inclusive of VAT amount. We want an exclusive VAT amount. So I say multiply by 100 divided by 114.5. So that answer over there gives me the exclusive VAT amount. Okay, so we're happy with that. But remember, only 50% of this amount will be paid over the 36 months. Only 50% of this amount will be paid over 36 months. So I say multiply by 50%, because 50% is paid up front and the other 50% is paid over the 36 months. So this answer over there will give us the 50% that will be paid over the 36 months, excluding VAT. But as you can see, I is a monthly amount, N is a month, refers to months. So PMT must also be months. That's very important to understand that I, N, and PMT must be the same. So I represents a monthly rate. N represents the number of monthly payments. Therefore, PMT must also represent months. So therefore, I must work out the payment per month. So now I need to divide by 36 because we're going to pay it over 36 months. So to get that amount, we're going to say equal 11,500, but 11,500 is inclusive VAT. So I say multiply by 100 divided by 114.5. So that answer over there is exclusive of VAT, but that is 100%. We're not going to pay 100% over 36 months. You're only going to pay 50% over 36 months. So only going to pay, what did I say? We're only going to pay, what did I say? Only going to pay 50%. So therefore, I'm going to multiply this by 50%. Okay. So that will tell that 5021, that 5,021, that is what we have to pay over 36 months. But we don't need the monthly amount, so I'm going to divide by 36. Okay, so the monthly amount we're going to pay is 139. Okay, so 139.50 is what we're going to pay monthly. Now, the future value is the lump sum payment at the end. There's no lump sum payment at the end. So that means we can work out the present value. Okay, so the present value would be as follows. Okay, so the present value would be as follows. So equal present value, open, I want N, I want PMT, I want future value, and then I want, I'll make it more. So the present value is that amount over there, okay? Now, the significant financing component is not that amount. The significant financing component is the difference between the 50%, the actual amount received, and the present value, okay? So actually, let me just, what can I do quickly? So I'm going to copy this out quickly. I'm going to leave it over here. Take that out over there. Okay, so now we're going to say the significant financing component is the difference between the 50% received and the present value. Okay. So 50% received, 50% received. What is a 50% received? It is this answer over here. It is that over there, excluding the 36 months. So the 50% received is, we received 11,500, but we want the exclusive VAT amount, 114.5 multiplied by 50%. Okay, so that is the physical cash we received if we exclude VAT. Obviously, the actual cash received included VAT, but we're busy with revenue, so we want the exclusive VAT amount. Okay, the VAT we will keep separately. Okay, and in the present value, I put in the right column, yeah. Then we're going to say, so remember, the significant financing component is the difference between 50% received and the present value. So the actual amount received was that. The present value is equal to that. Okay, so therefore, if we work this out, what you can see, the discounting component, the significant financing is the difference between the two, which is 1,000 Rand. So therefore, the actual transaction price. So the actual transaction price, therefore, the transaction price for this contract is, so the transaction price for this contract is that 35,000 is 36,000 Rand. So that is the transaction price. So this transaction price we will have to allocate, but remember the allocation of the transaction price is step number 4. Step number 4 was not required. Okay. So what I want you to do is you do step number 5. Okay, so you can try step number 5, where you try to where you see how it must be recognized. Remember, step number 5 is recognizing revenue. Revenue can only be recognized in one of two ways, either over a point in time or at a point in time. So you try to figure that out, and then if you have any questions on it, then you contact me. Do you have any questions on your side? Desiree, Madeline, Messi, any questions?
No, sir.
No, thank you.
Okay. Taurai, Shaila, Taurai, Walter.
Not from my side, Vice.
No questions, Vice. Thanks.
Okay, so please try to work through this. Is a very good revenue question. It basically covers almost all the main issues within a revenue that we need to know. So try to work through it nicely. If you have IFRS 15, try to sit with IFRS 15, sit with this question, sit with the solution, and try to work through it. And then if you have any questions, then just contact me, then we can set up another session to, or I can just discuss with you via WhatsApp of the key issues and where maybe I made a mistake somewhere, that we can see where I made a mistake, or just to clarify certain issues. But it's very important that you actually go and sit and work through this again, and not only use this session as revenue being done, because obviously revenue is a very big topic. So make sure you can work through it nicely. Okay, so that's all from my side. I'll see you guys again on Thursday. Okay. Okay, bye-bye.
Thank you, Vice.
Hey,
Bye.
bye-bye.
Thank you, Faz. Bye.
Thank you. Bye.
Bye.